Adam Odell is claiming that a rare 25-year stock Superboom is set to begin May 7th at 2 p.m. And those who move now could 10 times their money in the next year. In this video, I investigate the clues in this sales pitch to identify the stocks, so you don't have to buy Adam's newsletter to find out. If you appreciate me doing this for you, just drop a like and subscribe for more videos like this one. Also, no paid or proprietary info is given away in this video. It's all guesswork based on publicly available and free presentations. Before we do anything, let's look at Adam's stock picking history to see how good he is. In July 2023, Adam recommended several stocks, and the first was Twist Bioscience. This one has performed well since then. The second stock recommended in July 2023 was AIM Immunotech, and it has not performed well. AquaBounty was the third stock recommended, and this one has done even worse. Applied DNA Sciences was the fourth stock recommended, and this one was the worst of the bunch. In April 2024, Adam recommended Palantir, and this stock has been a home run. Also, in April 2024, Adam recommended Synopsys, and this stock hasn't been a home run. Also, in April, Adam recommended Pacific Biosciences, and this is another bad one. In August 2024, Adam recommended Enovix, and this has been another loser. In January of this year, Adam recommended three stocks, and the first was Taiwan Semiconductor. It's down 12% since the beginning of the year. NRG Energy was the second stock, and it's up around 7% since. Last was Astera Labs, and it's down around 50% since January. There are multiple stocks to reveal, so let's get started. Adam calls the first stock Superboom stock number 1, the underground AI chip maker. Here's what Adam says about the stock. This chip maker is in the automotive, medical, aerospace, defense, and mobile markets, and it's based overseas, meaning it's off the radar of most American investors. Yet, its most recent quarterly report revealed its revenue is up, plus its gross profit, net profit, and cash flow. This company also announced a partnership to use its chips for augmented reality and virtual reality. Not too many clues, but I think the stock is Tower Semiconductor and the ticker is TSEM. I think this stock is a borderline buy, and here's why. First is analog chip demand is exploding, and Tower's cashing in. Tower specializes in analog and mixed signal chips, which are in hot demand for cars, IoT devices, and AI systems. Their focus on these niche markets means they're riding a wave of steady growth as industries go high-tech. Second is resilient revenue in a shaky market. This stock's got grit. Even with a tough chip market, Tower's forecasting $358 million in Q1 2025 revenue, beating analyst expectations slightly. That kind of stability in a volatile sector is a green flag for me. Third is analysts are screaming strong buy, $60 price target in sight. Wall Street's giving Tower a unanimous strong buy rating with an average price target of $60, a solid jump from its current 40-ish range. That's a 30% upside that's hard to ignore. Fourth is AI boom could supercharge Tower's silicon photonics game. Tower's jumping into 1.6 terabits per second silicon photonics for AI and data centers, double the speed of today's standard tech. If they nail this, it could be a game changer for their growth trajectory. Fifth is global expansion equals big wins, new fabs, new cash flow. With $350 million invested in new plants in Italy, Texas, and Japan, Tower's boosting capacity big time. More production means more revenue potential as demand picks up. Sixth is undervalued gem, trading at just 15 times earnings. At 15 times trailing earnings, Tower's cheaper than giants like TSMC, which trades at similar multiples but with less upside room. This could be a value play hiding in plain sight. Seventh is auto sector wobbles could stall the rally. Here's the catch. Tower's tied to the auto industry, which is still clearing bloated inventories and facing EV slowdowns. If that drags on, it could cap their momentum short term. I'm going to reveal my guess for the stock in about 20 seconds. But before I do that, I want to remind you to click the link in the description to check out Alpha Picks. I reviewed over 100 stock picking services, and Alpha Picks performs the best and actually beats the market easily. If you click the link in the description, you get $50 off Alpha Picks. So go ahead and click that link and take advantage of this amazing deal. Here's everything Adam says about the second stock. Superboom stock number 2, the underground circuit board designer. This company designs circuit boards for AI. Last year, it formed a partnership with Nokia and is rolling out products for them this year. My system is flashing a super strong 92 rating on this stock, meaning jump on it right now. That's not a lot of clues, but Sanmina is a circuit board maker, and they have a long-standing partnership with Nokia. This is another borderline buy in my opinion, and here's why. First is undervalued gem or hidden trap. Sanmina's trading at around $76 with a price-to-sales ratio that's low compared to many tech peers, hinting it might be undervalued. But with a shaky market and a 12% drop in the past month, you've got to wonder if the discount is a steal or a warning sign. Second is profit growth. That'll make you look twice. Analysts predict a 25% profit jump in the next year, which is juicy for growth investors. The catch? It's not a high flyer like some AI stocks, so the upside might be steady but not explosive. Third is low beta bliss, stability in a crazy market. With a low beta, Sanmina is less volatile than the wild swings of the broader market, perfect for playing defense in this tariff-filled, uncertain 2025. Just don't expect it to rocket like a Tesla or Nvidia. Fourth is manufacturing muscle in a tech-driven world. Sanmina is a leader in integrated manufacturing solutions. Think components and assembly for big industries like medical and automotive. Demand's growing, but if trade wars heat up, those supply chains could get messy. Fifth is analysts are drooling. $92 price target. The consensus one-year price target is $92, a solid 20% upside from today's price, showing Wall Street's got some faith. Still, analyst targets can be optimistic. Don't bet the farm on it without digging deeper. Sixth is earnings power with a side of caution. Sanmina's net income grew 12% over 5 years, and it reinvests heavily, fueling that growth despite a so-so return on equity. It's a solid foundation, but nothing screaming next big thing here. Seventh is tariff tantrums could be a deal breaker. As a global manufacturer, Sanmina's exposed to tariff risks in this Trump-driven trade war climate. Recent market dips show investors are nervous. If you're risk-averse, this might tip it from buy to watch. And here's what Odell says about the last stock. Superboom stock number 3. The 99 rated dominator of a hidden tech. This might be the most exciting of all. Think of the last time you had your phone on vibrate mode. Or if you like video games, think of the last time your controller shook when you were playing Call of Duty and something blew up on your screen. It turns out there's a certain technology that causes electronic devices to vibrate in certain ways, depending on their role in your life. And one company is leading the charge on this almost hidden tech. This company has acquired thousands of patents on this technology, assuring they dominate the market for years to come. It boasts over 150 major tech companies as customers, including Nintendo and Samsung. This sounds like Immersion Corporation to me, and the ticker is IMMR. I'd personally pass on this stock, and here's why. First is revenue roller coaster, unpredictable income streams. Immersion's revenue is heavily tied to licensing deals and patent settlements, which makes it lumpy and unpredictable. Hardly the stable growth investors crave. One quarter they're up big, the next they're scraping by, leaving you guessing what's next. Second is Barnes & Noble baggage, a risky bet. Gone wrong. Their recent controlling stake in Barnes & Noble adds complexity and risk, tying Immersion's fate to a struggling seasonal business that muddies their core haptic focus. It's like buying a tech stock and getting a sinking bookstore chain as a bonus. Third is patent dependency. Living on borrowed time. Immersion leans hard on its haptic patent portfolio, but as patents expire or face legal challenges, their cash cow could dry up fast. What happens when the litigation wins? Stop rolling in. Fourth is valuation trap. Cheap for a reason. Sure, the stock might look undervalued with a low PE ratio, but that discount reflects stagnant growth and uncertainty, not a hidden gem waiting to shine. Sometimes a bargain is just a warning sign in disguise. Fifth is growth drought. Where's the expansion? Despite being in a hot sector like haptics, Immersion's revenue growth has been inconsistent, and they're not showing the aggressive expansion needed to compete in gaming, VR, or automotive markets. No growth, no glory. Sixth is shareholder stinginess, cash hoarding, over dividends. With a solid balance sheet and plenty of cash, Immersion could reward shareholders with bigger dividends or buybacks, but they're sitting on it instead, leaving investors with little to cheer about. Why invest if they won't share the wealth? Seventh is market momentum, fading. The hype is over. The stock's recent spikes came from one-off events like settlements or Barnes & Noble news, but the momentum is stalling, and technical indicators suggest it's losing steam fast. Jumping in now could mean catching a falling knife. And make sure to click the link in the description to check out Alpha Picks and save $50 on this awesome service.